So welcome to the VRE review. This is Vanguard's Canadian Capped REIT Index ETF. But first, I do want to give a shout out to Revax. They wanted me to do this ETF, and I think it is a very interesting one to request. So let's get into it. VRE, the fund seeks to track, to the extent reasonably possible and before fees and expenses, the performance of a broad Canadian real estate equity index. So currently, this Vanguard ETF seeks to track the FTSE Canada All Cap Real Estate Capped 25% Index. This is a lot going on here. Invest primarily in stocks of companies in the Canadian real estate sector, and I believe it is all of their holdings in the Canadian real estate sector. So, quick facts: the date was the date of inception is November of 2012. It's a market cap of $331 million with an expense ratio of 0.38%. Now, that is a little bit high for what I would like to see in an ETF. VTI and VRE have expense ratios at the 0.03, 0.05 range, which is basically nothing when you're talking about investing, right? $10,000, every $10,000 invested will cost you $38 to in fees. So not that big of a deal here, but it is something like six times more expensive to invest with VRE than it is with VOO or something like something of that sort. So some of the holdings that VRE contains, something like 23% in retail REITs, 17% in office REITs, 14 or 15% in real estate services, 10% in real estate holding and development companies, and then 5% in diversified REITs. Some of the top 10 holdings are Canadian apartment properties real estate, so that's CAR, car.un.to, RioCan, First Service Corp, Granite Real Estate, Allied Properties. Like there's other ones like Smart Centers and Choice Properties, First Capital Realty. I know of some of these from the past. I have invested with some of these companies before, so I do know some of them. To get into it, they are 100% invested into Canada. Nothing in that I have seen in other places. They only hold 18 investments. Now, I think currently it is 19, but they may change this in the future. The market allocation, there's nothing large cap here. Canada's small enough where everything is medium or small. So 43% medium, 43% medium small, and 13% small. So nothing too drastic here. So the top three holdings, Canadian apartment properties, RioCan, and First Service, and these three make up approximately 1/3 of the ETF as it is. So first, I'm going to go over these three, and we can see how they line up. So car.un.to, Canadian Apartment Properties, they have 66,000 units across Canada. They are the largest REIT in Canada by market cap, and they have a low payout ratio, as we see here, 50%. So they do have a lot of resources to invest with, and not just paying out to the investors. So I think this is very, very interesting. They are reasonably valued at about a 15 PE, so I think that is all right. Their price to sales is 7.5, which is extremely high. I am assuming this is due to vacancies and this sort of stuff, but price to book ratio is very spot on at 0.75. So they have their assets under control when it comes to properties and that sort. And same with RioCan. RioCan does have more commercial exposure. They do have a fairly high price to sales ratio, similar to Canadian apartment REIT. And again, that has to be due to vacancies, that buildings that don't have any occupants in them, and price to book ratio is also spot on. So their assets are under control. In recent years, due to COVID, they did cut their dividend. I think it was maybe a 30 or 40, maybe 30% dividend cut, but they have recently started to increase that dividend back to more normal levels. So that's not too concerning. It's about 4.8% yield, and with an increasing every quarter, every year now. So, they have a little bit of a higher payout ratio at 68%, 69%. So they do pay out more to investors than Canadian apartment real estate does. So not a bad investment, but more commercial exposure for sure. First Service Corp, I have not actually heard this one before looking into this ETF, and it's a very interesting company. They pay a small dividend, 31% payout ratio, with just under 1% dividend yield, but their chart and their price has significantly had good growth, steady growth over the last maybe 10 years or so. They're fairly large. They're about the same size as Canadian apartment real estate, at 7.5 billion. They have a slightly worse price to sales, but nothing too concerning at. Or sorry, slightly. They have a very good price to sales ratio, slightly worse price to book ratio. So I think they have good business cash flow and good clients, but they lack the asset value when it comes to actual property and assets. So this is they has growth has been rock solid for this company. I will predict that they will grow more in the future, but I also see that their PE is very high already, trailing PE of 47 and a forward PE of 25 and a half. So I think a lot of investors have already priced this company to where it will be in the coming years. So if you're looking to get into this particular company, I think it's a decent area to average into over the next months, maybe the whole year, because I think a lot of investors are pricing this company to grow in the future. So next is the distributions. Now, with REITs, you primarily want to invest into REITs due to the distributions and the how the REITs are organized. They do pay heftier dividends. This REIT VRE pays monthly distributions, which most REITs actually do pay monthly, with a trailing yield of 3.78%. And that's the same as the distribution yield. So over the last, maybe this is 10 years old, yeah, about 10 years, we've seen 57% or 57 cents of dividends, 105, 70 cents, 128. So it does fluctuate from year to year, but that is also probably due to the holdings that they rotate in and out. Maybe they allocate more percentages to larger yielding companies and REITs versus other ones in particular years. So nothing concerning there. Now, you can. This yield is not necessarily something. 3.78 is not high, but it's also not very low. Many banks, like Royal Bank and TD, have yields that are actually higher than this, that might even retain earnings a little bit better than some of these REITs. So I'm not too ambitious on REITs in general, but they are a place that will diversify a portfolio. So in summary, since inception, this ETF has returned 6.86% since its inception per year. They do have medium fees at 0.38, 0.38, yeah. So that's a little bit high for me to invest into an ETF for just 18 holdings. If you want to hold a similar ETF, you may as well buy maybe the top 3 to 5 holdings in this ETF to get the majority of the exposure. You would probably hold 60 or 70% of the ETF as it is. So but right now might be a good time to purchase these types of investments, as the market is suffering in this area. So it could be a good time to buy. Some of the drawdowns. So the best return is 15. This is a 3-month period here. 15.7% in March of 2019, and the worst return, 3-month return, is negative 28%, which is during COVID, right at the end of beginning of 2020. So that's the max returns you can maybe see, and drawdowns you can see in a 3-month period. since its inception, it's actually only lost been negative 2 years. The first year it was incepted, and in 2020, of course, and every other year has been 10%, half a percent. So there's been for sure years that have outperformed others, but it's not too outrageous in my opinion. So just a summary, I would probably not hold this ETF. Instead, I would probably purchase maybe the first 5 or 6 holdings of this company, and you would probably get like 12, 22, 30, 38, 40, like maybe 50% of the whole ETF by just holding those first 5 or 6 companies, and you wouldn't have to pay any fees to Vanguard. But if you are looking for someone to rebalance for you, this ETF would be beneficial. But it's not too hard to hold a couple holdings and rebalance yourself. So again, I just want to thank Revax for suggesting this ETF to review. And if you want any other ETFs, just please comment below, leave a like, and subscribe, and stay tuned for more ETF reviews and portfolio updates from